Bitcoin mining debt set for new records, but this time it's different. I'm going to pull up a chart in a second, but to quote from Wolfie here, the combined debt and convertible note offerings from 15 public miners hit a record 4.6 billion in Q4 2024, briefly reduced to under 20 million or 200 million in early 2025, and has since roared back to 1.5 billion in Q2. And I believe when he says reduced, I think he means that the raise is calmed down. I don't know. Maybe he's saying that some of this debt was all paid back, but a lot of that was convertible debt, which wouldn't necessarily be paid down yet. But if we hop on over to this chart from Matthew Siegel, he contextualizes it further. Total Bitcoin miner debt has eclipsed 20 billion as of mid-October, according to Van Eck estimates, which is just an absolutely staggering number and something that we wouldn't have expected a few years ago if it hadn't been for these AI pivots. Because if you look at the balance sheet of a lot of these Bitcoin miners and you look at their fundraising, what they will typically do is they've always leaned on equity because it's the easiest way for them to raise. They will dilute their shareholders, sell equity, and deploy that into CapEx to expand their operations. Because they haven't been able to access debt, like I said earlier, at favorable rates. Now, investment banks are willing to offer them convertible note, or willing to roll out the carpet for convertible notes. As we saw with TeraWulf, they're able to secure notes with their data centers. So now they have access to capital instruments that are much more capital efficient. They don't have to worry about dilution as much. And so we're starting to see them take on a lot more debt. But this mushrooming would not have happened without the AI and HPC pivot. And just one last thing to highlight. Last cycle, the debt that miners did have, and it was scant. Some of them secured credit facilities with like Coinbase or Galaxy with their Bitcoin holdings. Very few secured credit outside of that. That weren't ASIC backed loans. Core Scientific famously had a bunch of debt that was not ASIC collateralized by their ASICs or collateralized by Bitcoin. And, they went bankrupt in 2022. That wasn't just because of the debt, but they expanded pretty aggressively. But these miners would typically do ASIC-backed loans because that was one of the only ways that they could finance it. They would go through either Foundry or NYDIG or Ant Alpha. And, these were horrible instruments for any miner for anyone who knows how they were structured knows that they ended up being catastrophic because these ASICs are highly volatile. They depreciate very quickly. And when hash price takes a dip, as it did in 2022, when Bitcoin started cratering, then these loans were defaulted on, and they kind of created this cascading event. And then the lenders who lent the money are now find themselves with ASICs that are worthless and can't really produce much because Bitcoin is crushed and hash price is also crushed. This was all exacerbated by the fact that 2021 created this complete gold rush splurge environment in the US because China just banned Bitcoin mining. Hash rate got cut in half, difficulty got cut in half, Bitcoin mining was ripping, so it was incredibly profitable to mine Bitcoin. The ASIC market was distorted as a result, and these ASICs were wildly overpriced by the end of 2021. Like an S19 was going for $12,000 at the peak. And so some of these loans were collateralized with ASICs bought near the peak, and so the rest is history. A lot of them were defaulted on.
I mean, the miners didn't have an option at the time. There was like no other way to get money. So they just went with, there was just one game in town. And it was just really poorly structured, setup. So now it seems like debt can be used to grow companies. These types of notes and leveraging your infrastructure is a common way for companies to grow and take on debt so they can inject more money in capital. But so this seems like the modern evolution of that is improved. The market, time will tell. To me, it seems a lot more sane than last cycle. So, but we'll see.
Thanks for watching. Be sure to like and subscribe to the channel so you don't miss any of the episodes we put out. Also, check us out on Spotify, Apple, and elsewhere.